All right, well, pressure is mounting on the Fed ahead of next week's meeting as Wall Street continues to debate whether or not another rate hike is on the table. While data out this week showing that inflation remains high, the central bank is also closely watching turmoil in the banking sector triggered by the collapse of both Silicon Valley Bank and Signature Bank. Here to break it all down is Nick Timiraos. He's Wall Street Journal's chief economics correspondent. Nick, it's great to see you again. And we should also mention that you're essentially the Fed whisperer. You always have the scoop, it seems like, as of late. So, Nick, give us a better picture of how you think Fed Chair Powell and the rest of the Fed officials are thinking about the recent developments over the last week.
Well, credit is the lifeblood of the economy. And if you're having really serious credit problems, then it becomes harder to focus on anything else. So, it really depends, I think, on how this situation unfolds over the next few days. But if you're seeing a lot of turmoil in the market, that obviously makes it harder to raise interest rates. Even if you think interest rates are going to need to be higher, to get to where you're going, you need the car to be able to operate. And if the car is on fire, then sometimes you have to stop and deal with that before you get back and drive to where you think you need to be.
So, Nick, several firms have come out with their forecasts. JP Morgan, Morgan Stanley, they're expecting a 25 basis point increase. Goldman, no hikes. Is there a scenario where the Fed could say, we're not going to hike right now, we're pausing?
Yeah, of course, there's a scenario for that. You see it reflected in the market pricing. And I think a lot of these reports right now, these calls that analysts have to make, they're day to day at this point. I mean, a week ago, people were talking about a 50 basis point increase, and now we're debating whether it's 0 or 25. And this morning, you saw the markets, of course, pricing in cuts, 25% chance of a cut at the May meeting. So it's just an extremely fluid situation. And I think it's hard to, we've been in this environment watching the Fed. Things have been fairly predictable. And now we're in a different environment where it's hard to say what they're going to do because nobody has any idea what the world is going to look like when they get to the meeting.
And so is there a possibility that rather than looking at the data of the jobs report, a CPI, that they're just focused on what's happening with the banking sector right now?
Yes, I think that's very possible. I mean, I think your last guest, Michelle, put it exactly right, that to some extent, the data right now are in the back seat because they are reflecting financial conditions and economic environment that might not exist going forward. We'll have to wait and see. But there aren't a lot of good examples, at least that I'm aware of, where the Fed was hiking into bank runs or major, financial problems. You go back to 1994, when the Fed was making the kind of large moves that we got used to last year, 50 basis point increases. There was a 75 basis point increase in November of 94. But Greenspan really in 94 was not making those large of moves at consecutive policy meetings. They would do 50 and then skip 75, and then they skipped in December of 94. Because you were having the Mexico peso crisis, and then they did one last 50 in January of 95. So this is just a very different situation. It's not as if the Fed can go say, oh, here's what we did, during this episode or that episode. You have high inflation and you have some, banking issues that potentially look more serious even after what we're seeing as maximally aggressive actions on Sunday night to try to diffuse this whole thing.
Nick, many people are asking where the regulators were as SVB did crash. Some questions just about how SVB was able to have so much risk within their business. Do you at all think that the crash at SVB, has that at all hurt the reputation of the Fed and more specifically Fed Chair Powell?
Well, I guess that'll be for others to decide, but you're already hearing people talk about, yes, this is, after the challenges they've had on inflation, this is not something that makes their lives easier, that makes their reputations look better, right? I think we can agree on that. And so I think the question here is, as the facts come out, what will we learn about what they were telling the bank or weren't telling the bank? You had obviously easing of regulations, potentially less muscular supervision, though we'll see, what comes out on that. And you had a central bank that was moving interest rates very aggressively. And to the extent they were focused on financial calamities, a lot of the emphasis had been on the non-bank problems, the things we saw 3 years ago in March 2020, treasury market intermediation, money market funds. You didn't see a lot of focus on interest rate risk management inside the non-GSIB, the small and mid-sized banks. So yes, there are going to be tough questions to answer after the Fed gets through dealing with what they're dealing with right now, for sure.
And lots of interest in what Fed Chair Powell is going to say next week as well. Nick Timiraos, always great to have you. Thanks so much.